Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX Global, bringing you the morning comment for the 7th of March. China lowers growth target. Chinese officials laid out a 6.5 to 7% growth target for 2016, down from the previous objective of around 7%, as the world's second largest economy struggles with softening domestic economic activity. The country also plans to expand its budget deficit limit to 3% of GDP from 2.3% in 2015, a step that would allow the government to increase spending or cut taxes on corporations to encourage investment. From the monetary side, the money supply is expected to increase by 13%, up from 12% last year. The combination of larger budget deficits and more accommodative monetary policy is intended to halt the economy's slowdown. Aussie and New Zealand may extend their recent gains on speculation that their exports to China will increase. On Friday, the US jobs report for February showed solid employment gains, with non-farm payrolls increasing by 242,000 and the unemployment rate staying unchanged at 4.9%. The participation rate rose as well, as more people were encouraged to enter the labor force. The negative spot in the report was the slowdown in average hourly earnings, which suggests that inflationary pressures from wages may remain subdued in the near term. Even though the increase in the participation rate is encouraging news, more people in the labor force may ease somewhat wage pressures going forward. Overall, the report showed a continued tightening in the labor market, which in our view brings forward the expectations for the next rate hike. In any case, the attention now turns to the March FOMC policy meeting. Expectations for a hike at that meeting are minimal, but everyone will be looking for hints on which of the upcoming meetings is the most likely for the committee to increase the Fed fund range. The calendar today looks relatively light, but we have a very busy rest of the week. Today we get Norway's manufacturing output for January, but no forecast is available. As for the speakers, we have Fed Vice Chairman Stanley Fischer and Fed Board Governor Lael Brainard. As for the rest of the week, on Tuesday, China's trade surplus is forecast to have narrowed in February due to a faster decline in exports than in imports. Further deterioration in trade activity could add to evidence that China's economic activity has not stabilized yet and may cause Aussie and New Zealand dollar to reverse some of their recent gains. On Wednesday, two central banks hold their monetary policy meetings: the Bank of Canada and the Reserve Bank of New Zealand. At its latest meeting, the Bank of Canada kept its benchmark interest rate unchanged and noted that the lower Canadian dollar, as well as fiscal stimulus, would help to offset the drag on economic activity from plunging oil prices. Since the anticipated fiscal measures in this month's budget have not been introduced yet, and the painful impact of plummeting oil prices have begun to dissipate somewhat, we expect the bank to remain on hold at this meeting. As a result, the reaction in the Canadian dollar will be determined by the tone of the statement accompanying the decision. The Reserve Bank of New Zealand also held its fire at its latest policy meeting, but signaled that further easing may be required over the year to ensure that inflation moves towards its target range. After that meeting, data showed that inflation slowed considerably in the fourth quarter and is now one touch above 0%. As a result, we believe that the bank is likely to cut its policy rate by 25 basis points at this meeting, which could cause the kiwi to weaken. On Thursday, we have the long-awaited ECB policy meeting. Conditions have worsened since the latest meeting, as Eurozone's inflation slipped into the negative territory. Investors currently expect a 10 basis points rate cut at this meeting, but with regards to what other tools may be employed, the market looks to be divided. The available tools include extension and/or expansion of the QE program or technical adjustments to the existing purchases. We believe a deposit rate cut and an extension of the existing program could be the preferred path for the bank. That said, though, we have to warn that the risks of this meeting are tidal to the upside for the euro. Markets already expect substantial action based on Draghi's recent remarks. So if the bank delivers again, as it did in December, we could see the euro surging once again. Finally, on Friday, we get Canada's employment report for February. The unemployment rate is expected to remain unchanged at 7.2%, while the net change in employment is expected to have turned positive. This could support the Canadian dollar somewhat, at least at the release. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX Global, wishing you solid trading.